welcome to the Biz Coach Show, hosted by My Biz Coaches and presented by the TLG Group. Our show is focused on giving entrepreneurs the edge they need to succeed. Your hosts today are David Macon, that's me, and Eric Whitmore. Eric, how are you doing today?
I'm doing excellent, David. Thank you.
Awesome. Well, always good to be with you, and excited to talk about our topic for today. Really ripped right out of the headlines, as we often like to do. So before we jump into that topic, please take a moment, if you're watching or listening, to subscribe. We don't want you to miss future episodes, and we put out a lot of good content, introduce a lot of awesome guests that have a lot of great insight to help you either start or scale your business. And we'd love for you to watch all those episodes. So don't miss out. Be sure to subscribe. Today, we're going to be talking about the Silicon Valley Bank, or SVB, and really the shockwaves that have come from all of the difficulty that has happened with that bank over the last couple of weeks. And so to start things off, we're going to just kind of give a quick timeline, just in case you've maybe missed the headlines or you've heard about it but aren't quite sure exactly what's going on. And then we're going to take that and really look at it from the lens or the perspective of a small business owner. What are some of the things that we should be thinking about? What are the lessons that we can learn, and what should we change as a result of what's happening with banks right now today? So as we kind of look at the catalyst for all of this, really kind of the start of 2023, Silicon Valley Bank started to have a lot of their deposits start to decline by about $25 billion or 13%. And that was really as the Federal Reserve was raising interest rates. And so with that, Silicon Valley Bank had also invested very heavily in bonds that had started to perform poorly as a result of rising interest rates. So that's kind of the backdrop. And then really kind of the last straw, so to speak, was that on March 8th of 2023, SVB announced it would book a $1.8 billion loss after selling some of its investments to cover increasing withdrawals. And that led to Moody's, which rates banks, downgrading SVB Financial. So that was kind of the big thing. And then March 9th is really when, the markets opened, SVB's financial stock really crashed. So really bad, along with shares in 4 of the biggest U.S. banks. And a lot of them were forced to close, taking losses. And that was a way to raise cash. So within that, the declines wiped out a combined $52 billion in market value from JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup. And so then as all this is happening, you have all these venture capital firms are pulling their money out of Silicon Valley Bank, really kind of creating a run on the bank, right? And urging other, capital firms and people to pull their money out as well. And by the time SVB closed their doors for business on that day, depositors had attempted to withdraw over $42 billion. And so, that's really when things were starting to get super ugly. And that's, I think, is, the news and social media was really kind of inflaming that as well. And so fast forward just another day to March 10th, we start to see SVB, basically all of their shares were halted as of Friday morning after a pre-market sell-off. And then that's where federal regulators announced they had taken control of the bank and officially became the second biggest bank failure in U.S. history. So that's why this is such a really big deal, it is pretty unprecedented historically. So after that, March 11th and 12th, kind of over the weekend, a lot of tech startups who were the primary customer base of SVB, they're scrambling, trying to find alternative funding sources to, make things like payroll and day-to-day operations because all their deposits were locked up in the failing bank. And so that was a big deal. And then on March 12th, as worries of bank runs spread to other banks, federal regulators, this would be Sunday then, unveiled emergency measures to stem the fallout from SVB. So that kind of brings us full circle to where we're at. We're recording this just a few days after all that on the 17th of March. And there's still a lot of kind of uncertainty of, is this isolated? Is this going to continue to affect, every bank, my bank as maybe an individual or as a small business owner? And so that's kind of the environment we're in as we record this today. So Eric, as we kind of look at all this, I think you and I, as we were prepping for the episode, really wanted to look at, not adding to the panic, the hysteria, but really understand this and then really subsequently take it and think about it from the perspective of a business owner and what can they do with this information? What can we learn from this? And what action should we be taking? So I'll just kind of tee it up. Anything that maybe you've uncovered as you've been investigating SVB, or anything as you were prepping for the show you want to share before we jump into maybe some of those key points for our audience?
Yeah, so there's some pretty significant takeaways that I think are valuable for us to really kind of dig into. And again, we don't know everything that happened, right? So we're speculating on some of this stuff. But one thing is clear: good, sound business practices were not being used. I think that's been demonstrated on multiple occasions. I've gone through a number of sources to confirm some of this information, but and obviously we're not advisors, we're not giving advice. But the one thing you have to remember, is it doesn't take a brain scientist to figure out what's good business practices. And at the end of the day, the reality is there's a lot of what I want to say. What's the term I want to use? Red flags that should have been acknowledged much much sooner. So a couple of thoughts. One, in one of the articles I was reading, there was a story about the CEO was actually behind stage at an event where they were about to announce SVB as I'm going to get the terminology wrong, but the number one bank, whatever, for the fifth year in a row. I don't know what the criteria was or whatever, but there was I don't know if it was the best bank or what it was, but it was some pretty significant recognition that they were about to get. While they're standing backstage, they're getting the call from Moody's on the downgrade. Right? I mean, we're laughing, but that's pretty bad, right?
Yeah. Right.
Wait, hold on. Let me take my trophy, and then let me take this call.
Yeah, for sure.
He was literally that's the what was shared, right? So, I mean, if that's even close to being accurate, even if it was the day before or the day after, for that matter, I mean, that's anyway. So and there's a lot of dissension in regards to whether, as the government steps in, and certainly the government stepping in and doing what they did in regards to backstopping the losses, right, for the existing companies. The companies had money in that bank. I don't think anybody would fault the government for doing that, although there is a lot of dissension in regards to a bank bailout, right? Which lots of thoughts reminiscent to 2008 and the bank bailouts that we dealt with then. And much of that was self-imposed, right? Well, ironically, as we dig deeper into this story at SVB, a lot of it was self-imposed. So, for instance, the chief risk officer, and I believe it was in the spring of 2022, stepped down from the role and was actively taking a salary for 6 months. I believe that's, to be accurate, actively taking a salary for 6 months, had stepped down, but they didn't fulfill the role. Worse yet, the role did not get filled for up to 9 months. So at a time when the Fed is openly acknowledged, hey, we're increasing rates. This is a huge impact. And for those of you who don't understand how a bank operates, and I'm not certainly going to suggest that I'm a specialist, but we did have a really super smart bank CEO on our show just a few weeks ago, Thomas and Sarah from the Integro Bank, who spent the better part of his career, at least a big portion of his career, actually reconciling failed banks. That was he spent quite a good number of years doing that, and shared with us some insights. But my point is that the without having a chief risk officer in place during a time when the Fed is increasing rates and a large number of your performing assets are locked in at a rate of 2%, which was the prevailing rate 2 years ago, 3 years ago, 4 years ago, that was kind of like the standard. Now with the rates at 5%, you're out of balance, right? I mean, there's no way that you're going to be able to support that. So they knew they had assets they needed to unload, and they weren't unloading them. And what caused the run on the bank, to your point, David, was the fact that they tried to dump $21 billion of I don't want to call them toxic asset because that's been way too played, but basically those are not ideal assets because they are mortgage-backed securities in many cases at a much, much lower rate than what the prevailing rate is. And consequently, what ended up happening you dump that much business out there at one time, and that's going to cause a run on the bank, right? I mean, and in addition to that, the messages started getting around, and now all of a sudden everybody's kind of like the investors, the people who have money in the bank are hearing about this, and that's going to throw up red flags and cautionary signs, and so they're like, let's just be safe, let's pull our money out. Well, for those of you who don't know, a bank, generally speaking, if a bank has, let's say, for instance, $100 million in assets, in deposits, they're allowed to loan out at a 10x ratio. Meaning if I had $100 million, I can loan up to $1 billion. But I only have $100 million in the bank, even though I've loaned out up to $1 billion. And even then, just because I have $100 million in assets, as far as deposits, if I have $100 million in deposits, doesn't mean I actually have $100 million in the bank.
Yeah.
I'm only required to keep a percentage of that. So we're dealing in derivatives. And when you think through that, it doesn't take much for a handful of big clients to say, you know what, we're not comfortable where our money's at right now. We're going to pull it out. And they try and pull out, 100, 200, 300, 400, 500 million dollars, let alone $2 or $3 billion on 100, I think it was 109 billion or 108 billion or something like that. I don't remember exactly what they had, but you start talking about pulling out hundreds of millions of dollars, and that's a significant impact when most of those banks never have that much cash on hand. That because it's all invested, right? It's all invested somewhere else, and they're making money on the arbitrage, which is the difference between what they can loan it at versus what they're paying for to hold the money, right? So if you take the time to read any of the articles, and make sure you're reading the good articles, the quality writers. Somebody else quoted me. Oh shoot, I have to find it now. Here it is. There's a Wall Street Journal article by Kim Strassel was talking about specifically the new Green Deal when that was promoted last year. And the reason this is important is because SVB was actually supporting a number of these green initiatives, business models. So what the government does is they get an idea in their head, and they decide, hey, we want to support a particular business category, for instance. And let's say, for the sake of argument, a good example would be solar. Well, if you know anything about solar, and you know the business model of solar, the business model of solar as a standalone without tax credits is not necessarily a profitable business model. Now, I'm not talking about the local guy selling solar to the average Joe. I'm talking about the overarching business model as a whole for what would incur hundreds of millions of billions of dollars in investment into that business category, right? So the only reason that people would dump that kind of money into a business category like that is because the government's offering tax credits, significant tax credits that help support and justify the added investment into that business category, because you're betting on the come, right? And the whole idea was to generate new jobs, right? So there's nothing wrong with the logic behind it. The issue becomes when you're trying to prop up a business category like that and try and drive more, more jobs, more revenue, more business opportunity, whatever, and you're pushing on a category of business that by itself, in and of itself, is not necessarily a profitable business category without the tax credits, then something like this takes place, right? Which, by the way, a number of those types of companies were actually banking with SVB. So there's just a lot of pieces that kind of come into play as you tie all these pieces together and recognize there's some significant concerns. There's a previous contract employee for SVB had a conversation with that individual, and they acknowledged, they said, if you're a discerning individual and you saw that the way they were spending money on the initiatives that they were spending as a bank, as an organization, as a company, if you saw the way they were spending money on the different initiatives they had within the organization, you would have thought, okay, this is a Ponzi scheme. And as I use that term, I apologize for that, but it's very much a house of cards, right? That was kind of the not the terminology, but the kind of emphasis they put. And so the reality is this, it kind of comes back to, to your point, David, what does this mean to the average business owner? Well, at the end of the day, the reality is if you look hard enough, there was more than enough red flags that should have been caught by the people that know better. And so then you have to ask the question, did they know better and choose not to pay attention? Or did they not know better? And in which case, then, now you're talking about a whole nother conversation, right? So is it, and I don't think that anybody didn't see that. If I had read any of these scenarios, I probably would have said, that's a concern. I think I don't want to be invested here and I want to pull my money out. And now there was one other piece to that I would share. When we talk about FDIC security, right? The $250,000, if you understand the $250,000 FDIC security that's in place for every depositor at a bank, they're guaranteed up to $250,000. Now, here's the thing: when you're a smaller bank like that, and you deal with investment companies, right? And you're dealing with a lot of companies that have big chunks of money. Theoretically, you would think that they know and understand. They should have the business acumen to know and understand that their deposits are only guaranteed to $250,000. So if you had a couple $100 million in the bank, you should actually be spread around amongst more than one bank, right? And I don't mean a different branch. I mean actually an entirely different bank. Now that doesn't always make sense because part of the strategy of the bank is to try and get as much of your deposit money from you as a business, and you get added benefits for that, right? There's value in that. But the downside to that also is there's a lot of inherent risks, and the FDIC is not insured beyond the $250,000 per deposit account, and consequently, a sophisticated business, and I'm saying that if that's somebody who's got tens of millions to hundreds of millions of dollars in the bank, they should know that that's not guaranteed. And that's where some of the, again, rub or dissension comes from, the fact that people are like, well, this feels like a bailout of these big companies because they were not disciplined with their banking strategies or financial strategies. So anyway, to kind of bring it full circle, I think it's important for us to really kind of think through. There's a lot of things that make this feel really uncomfortable. In addition to the SVB, there was also Signature Bank and I believe one other bank that felt similar challenges. I don't know how much of it was directly related to SVB. I couldn't be able to speak to that. But when you hear of a couple of different banks failing, then immediately your antenna goes up and you're like, whoa, hold on a second. What's going on here? All the banks shutting down again. Are we going to run into another issue? Well, then that just exacerbates the run on the first bank because now there's multiple banks failing out, right? So again, all of that to be said, I say to the average business owner, one, make sure you do your due diligence. Know where you're banking, right? Know where your bank is investing their money, or your money, I should say. Know what they're doing, what's their strategy. Know, first and foremost, that a bank's strategy to make money is to loan it out, right? Now, and what terms they loan it out, there was some questionable loan approvals that were provided to some of the people in these not startup banks, what do I call them? I guess some of them were startups, but the point is that some of these banks were, some of these businesses, were relatively new and did not have solid financial business models, right? In some cases, because they're still ramping up, right? There's lots of times where they have startup capital and they haven't necessarily proven profitability yet. But you got to make sure you're holding on to your cash. So again, it's like you look at that and say, okay, well, if a bank has a lot of those types of depositors, that would make me uncomfortable. So for one bank to really focus a lot of attention on categories of business like startups and venture capital backed companies that are that don't have a lot of proven revenue streams yet, or for instance, I talked about the new Green Deal, right? You got a business model that's not completely vetted. A lot of people complained about Tesla when Tesla first started making a play in the car industry. Elon got a lot of grief because his financial models in the first couple of years, when they were showed a profit, people were like, well, it's not really profitable because if it wasn't for the tax credits, you wouldn't be profitable, right? And so that's a perfect example of if you had a bank that had a lot of clients like that, there's a legitimate reason to show concern. And so again, the question becomes down to, did people actually pay attention to the red flags so they just avoid them or ignore them because it was financially beneficial to do so? So
yeah.
I'll stop there to let you kind of offer your 2 cents, but I want to bring it home with that thought of what does that mean to the average business owner?
Yeah. I know it's interesting. I'm sure, you and maybe some of our listeners, when all this was going on, the visual that kept coming to my mind was It's a Wonderful Life, right? There's a run on the bank. And so that was the visual I had. But I think it's important to recognize, and as you pointed out, you're talking about a very different client than what we saw in the movie. These are, companies with millions and billions of dollars. And when they make a run on the bank, that can have some big ripples. And so, yeah, it's definitely controversial. The government stepping in and actually know quite a few of the tech companies that banked with SVB that, they're starting or they're growing and relied on that for funding. So totally get the human element of it with, trying to make payroll and make sure, we keep the lights on and keep, customers happy that are, engaging with these startup companies. And so I get that piece of it. But then, what's the signal that sends, right? And I think that's really what we're talking about today is, what does that mean for the future? And part of that's we're going to have to wait and see. But I think, we could take that approach, or as you and I like to talk about, that's not an effective approach for the small business owner. So I think for most individuals, with their banking, probably not a big deal. But for a small business owner, you may have, a lot of money in a bank, well over that $250,000 FDIC, insurance amount. And so what should those individuals or those businesses be thinking about? And so I think maybe we start, Eric, where you talked about evaluating your bank. And so I think a couple things to look for is, first of all, is the bank FDIC insured? I think that's of course an important starting point.
Sure.
You talked about kind of loan to deposit ratio. That's an important metric. Capital ratios, profitability of the bank, right? Those are all things that we can be looking at. And I think, if somebody has never looked into that before, there's a ton of websites out there that measure things like that. You can go as basic as like bank rate, or you can go to it's the FFIEC, which is the Federal Financial Institutions Examination Council. Bit of a word soup there, but they they have some really detailed reporting, and they actually have a Uniform Bank Performance Report, the UBPR, and you can find your bank on there, and it has a lot of that information, and you can really get into the nuts and bolts of your bank and their financial performance and some of those different things. And so I'd say that's probably a good starting point. And Eric, I know you feel similarly based on your comments, but anything that you would add, and then maybe we can talk about kind of diversifying a little bit next.
Yeah, I think the everything you suggest is dead on, right? I mean, the main thing is do your own due diligence. The at the end of the day, if 2008 didn't teach me anything, it definitely taught me to do your own due diligence. Yep. There is and has been for a number of years this belief that if you're Ivy League educated, and this is no knock on education or anybody from an Ivy League school for that matter, but if you knew this, if you have this level of education and you're in the financial industry, you know how to invest, and that probably couldn't be a further assumption than from the truth than anything else. The reality is, at the end of the day, it's there are significant numbers of people that are as capable of making those types of investment decisions as anyone else, but it requires due diligence, and most people don't want to take the time to do the due diligence. Now, if you have the money, if you have the resources, and you can pay somebody else to do the due diligence for you, well, that's what you're paying for. You're paying for somebody else to do that due diligence for you, and they pay a lot of money for that, right? And that's why you have private funds and things like that. But a bank isn't necessarily, a bank's not a private fund, right? A bank is designed for your average everyday business owner or depositor, depends on the business owner, public bank, or for traditional clients. But the point is that the smaller banks that are probably designed with the small business owner in mind, that when you're looking to put your money into a bank, you have to be willing to make that due diligence. And if you're, if you're the average Joe and you got a cleaning business or a landscaping business, or you do carpet cleaning, or you do I don't know, turf install or something like that, you're not getting north of, well, depending on the size of the business, if you're not getting north of $250,000 in your account, none of this really makes a big bit of difference to you, other than the sense of security, which if anybody doesn't appreciate that anymore these days. So that would be a major thing on my mind anymore. But and in 2008, everybody felt like, oh, this would never happen again. And it was all because of the mortgage securities and all that kind of stuff. Well, some of this was mortgage security related, but it wasn't just mortgage security related. And quite honestly, here yet again, it happened with a couple more banks. So the reality is, at the end of the day, was it the caveat emptor, buyer beware? When you're looking for, if you're a business owner and you're looking to put your money somewhere, you need to do your own due diligence. And I know that sounds trite, and it sounds like, oh, well, yeah, of course. Well, yeah, most people don't. For the same reason that most people don't when they sign an agreement, they don't read all the legal detail. Well, they don't have a vested interest in screwing me, so I should be okay in signing this agreement. But what you don't realize is oftentimes there's something in that agreement that push comes to shove at the end of the day, it's not in your best interest. The contract's always written in the other party. Whoever wrote the contract is the one that's in control of the agreement, right? So same thing when you go to a bank. The bank terms, right, are based on what's good for the bank, not necessarily good for the depositor. Now, the idea is, if you do your due diligence and you figure out, what does this bank stand for? What do they support? Who are their ideal clients? Now you get a better feel for, whether or not this bank would be a good fit for your business. And as I said, if you don't do the due diligence, then you're basically putting yourself out there and you're exposing yourself. And this is obviously much bigger because there's a lot bigger companies than the ones that we would typically be dealing with, but it doesn't change the fact that you should still be doing this regardless.
Yeah. And I would just add, just to expand on what you said, not only is the bank a good fit, but is it a safe fit, right? That's really what you have to evaluate. And that's where, just going beyond, I like the guy I talked to, or, they had some favorable rates, or, I like some of the perks they offer, right? Those things are great, but you really got to, kind of pull back the curtain and look at some of those financial measurements, because that's really going to determine if it's, solvent or not.
Absolutely. And I'll share this. There was I can't corroborate this, so I'm not. I'm just bringing it up as a thought. There were some reports of some less than credible loan practices with certain clients, and one of the strategies that often happens with the company as they grow and scale, before they're really financial or cash rich, I should say, they have equity, right? And the equity is worth a certain amount of money. Well, a bank will often come in and loan. For anybody who's seen We Crashed, that's a prime example of exactly what I'm talking about. The business wasn't making money yet, but it was worth, billions, at least hundreds of millions. I don't remember exactly at what point, but they were willing to loan the owner, the CEO, who was a large stakeholder in the business, millions of dollars at low interest rates. Of course, that was at that time, but at low interest rates. And he didn't have, other than the equity in the business, he didn't have any way to pay the loan back per se, right? It's something that they do for investment in the investment banking world to help those people, those individuals, when they're in that startup phase, because they haven't capitalized all the growth and opportunity within the business yet, but they still need to eat and they still need to do what they do. But when you give out millions and millions of dollars on a bet, for lack of a better term, everything in business in general, you're always taking a chance. So, but they would loan out lots of money to these individuals. And the question is at the end of the day, if they couldn't demonstrate the ability to pay it back, they wouldn't do that for me, right? I got a mortgage. If I don't put my mortgage up as collateral for a loan to buy a business or something like that, if I'm not willing to, if I don't have a good credit score, they're not going to loan it to me. Why would they loan it to this person who has equity in this business, but the business hasn't been vetted yet? It's not much different. So the question becomes, how does that take place? And so when you have those questionable practices, it makes people, again, leery. And so my question would be, if I knew that a bank was making those types of loans, I'd probably be like, yeah, if they'll give me a loan, I'll take the loan, but I don't think I want to put my money there.
Yeah, right. Well, and I think that's one of the unique things specifically about SVB and why this compounded so quickly is you've got, SVB up here, you've got, these tech companies that, to your point, I mean, they can go a really long time before they're profitable because they spend so much time, building the software and the infrastructure and the database and the UI and right, all those things that go into it. And then they finally start getting ad revenue or subscribers. And so it takes a really long time. So you've got them, getting loans potentially, but then they're also funded by, these venture capital guys who are also banking at the same bank. So now you've got this double whammy that, we're both in the same bank and we're both kind of banking on the success of each one of these organizations. And then when you start pulling out of that, it's just it's a recipe for a bad situation. So just more so even than a normal bank if it's centered on tech and startup. So just interesting note there. So good call out.
Yeah, no, great point.
So cool. Well, let's talk for a minute then about kind of diversifying, because I think that's one of the big takeaways from this, especially, like we mentioned, if you're, well above that, $250,000 range and, maybe you've got millions, tens of millions, et cetera, what should you be thinking about with diversification? So one of the things that I came across as I was kind of doing the research on this, one of the recommendations was considering mixing smaller regional banks with some of the larger national players. And so I think that's a really interesting strategy. And this is something that we talk about, not specifically with funding, but with supply chain, right? With COVID, we saw the supply chain disruption. So we're always talking about exploring alternatives. And we're not necessarily saying you have to, split your money equally across all these different banks. But what happened is when SVB, kind of closed their doors and was trying to minimize the fallout, people couldn't get to their money. And so if you at least have money and funding sources a couple of different places, it sounds like everybody at SVB, they're going to be made whole and they're going to be able to get their money and the government's helping make that happen, right? However you feel about that, that sounds like that's what's going to happen. But if you have to make payroll tomorrow and you can't get your money today, it really helps to have those other options, to have cash parked in a couple of places and have those funding sources available. So that's just one strategy I came across, Eric. I don't know if you've encountered others or if you advise your clients on other strategies, but would love your thoughts on that.
Yeah, no, it's actually a valid point. And I'm generally speaking, and I don't want to share a bias that's inappropriate, but I'm not a big fan of bigger banks, but not because of the reason that a lot of people assume, more so just because when you're a small business owner and you're trying to grow your business and do what you need to do to grow your business, you kind of want a partner. Big banks, generally speaking, aren't partners. They're there to service their clients, right? They do what they do. They're there to make their money. But we saw in the for those of people who went through this during COVID, PPP. And, we saw it more here in Phoenix than maybe in some, or I say in Arizona specifically, than maybe in some other states. But as we remember our conversation with Thomas, when he was on our call from Integro Bank, he reminded us that Arizona is one of the most underrepresented from a banking institution perspective for the average small business owner in Arizona is probably one of the lowest in the nation. I think it was the lowest in the nation, right there along with Nevada and California with the other two. And I bring that up. The reason that's relevant is because during COVID, if you were trying to get money for PPP, and first of all, the smaller banks weren't even available. When the first tranche of PPP, the ones that had the money were the Wells Fargos and the Chases and the Bank of Americas and those guys. And they're the ones that were funding the deals. And guess who the money was going to? It wasn't going to the guy that needs $78,000 to cover payroll for a month or two. It was going to the company that had millions of dollars, right? And needed to cover $1 million payroll run or whatever. And they were getting $3 and $4 million. And it's because at the end of the day, they were making 1% on the loan. I mean, think about it from sheer math perspective. Would I want to make 1% on $78,000 or 1% on $1 million? It's going to take me the same amount of effort, by the way. Yeah. Right. So I'd much rather make 1% on $1 or $2 million than 1% on $78,000. So I remind people that when we went through that, there's a lot of people that got the pinch because the big banks just didn't worry about the little guy. So that's my bias, right? I'm sharing that openly. And I think that it's prudent for small business owners to have, to your point, to that's where I would look for my relationships. But then two, David, you bring up a really valid point in that, maybe you do need to have a backstop with a larger bank where you park some of that cash as a backup. And there's probably not a bad strategy. I'd honestly have to stew on that to decide my moral dilemma. But logically that makes sense. And certainly at minimum, to your point earlier, having a few different banks. If it was me, I'd probably pick a few smaller, and I say smaller and regional, right? You could do the local and the regional banks, and get a similar split. But it's who's going to serve you. At the end of the day, you're putting your money in the bank. The bank basically loans your money back to you. It's your money that they're loaning you. It's somebody's money that they're loaning back to you, and they're making money on the arbitrage. So at the end of the day, if you're putting money in a bank, make sure you're getting the services from it. And I think that as to our clients out there, one, we've obviously made it abundantly clear to make sure you do your due diligence, but then two, make sure that it's a bank that you want to work with. Make sure it's people you want to work with. And I think that that's an important component as well. And you may have to do that with 2 or 3 banks to make sure that you are diversified well enough. Again, some of this is overkill for somebody who doesn't have a bigger business, but if you're in the 1 to 10 million in range as far as how much cash you move through your bank account in a given month, you probably need to consider 2 or possibly 3 banks just to hedge your bets.
Yeah. I'd say especially right now in our current environment. I mean, if
Absolutely.
You're not already doing that, I mean, it's the right environment to make that kind of diversification play.
Yep, absolutely.
Yep. Cool. Okay. Well, something else that kind of got me thinking with this whole thing is if you're a business that relies heavily on loans for your business operations, which that's what a lot of the SVB companies, deal with or have dealt with. I think it's important to note that that's going to become increasingly challenging in the environment we're in with rising interest rates. And so one of the things, Eric, I know that you do, and I'll give you a chance to shamelessly plug your coaching if you'd like, but is looking at where can we reduce expenses, how can we increase our revenue, and maybe even find additional revenue streams. And so I think that's something that's really important to look at, because if we are that reliant on that funding, on those loans, it's just going to get harder, right? It's going to get harder. I mean, I'm sure there's a light at the end of the tunnel, but the immediate reality is we're in a higher interest rate environment, and that's likely going to continue. And so if we can find ways to be less reliant, that's certainly an important thing to consider. So any thoughts on that?
Yeah, a valid point. It's interesting. People don't realize that the bigger you get as an organization, the more you have to you can't avoid using credit. Like I have some smaller clients that, they pride themselves on the fact that they never had to take any loans to build their business. And that's a great thing to hang your hat on, right? I mean, it's amazing to be able to say that. The reality is you also have to ask the similar question: how much growth does that cost you? Right? How many opportunities have you had to pass on because you didn't have access to capital that was necessary to do some of the things you needed to do? And often we can lose sight of that in the intent of being, super conservative. Now, at the same time, there's absolutely nothing wrong with being conservative and knowing that you're only spending what you can afford to spend, right? So I'm not knocking that by any stretch, but I do believe there's opportunity loss, all right, with opportunity costs, with not looking at what you could do with a line of credit. So, ironically, 2 years ago, you could have had a line of credit for your business and probably paying 2 points on it. And, you could have had access to a couple $100,000. And if your business is doing $1.5 million, $2 million a year, and you got access to, let's say $250,000 and at 2%, that's a nice backstop, just to cover something. If something falls short, you got to do some big equipment purchases you weren't anticipating or something like that. I mean, that's why you do what you do, right? You also have seasonality factors. I mean, for years we were in retail, David, and the going joke was what we call was it Black Friday? Because as of Black Friday, that was when you actually turned the profit for the first time all year in retail. That's why they called it Black Friday. That's where the original term came from. I don't know how accurate that is, but that's what I've heard. But the point is that you need to have access to capital or to capital through lines of credit to be able to do that. So, making sure that you know how to do that is important, and how to do it intelligently, right? If you're not comfortable with that and you're in that scope of business, you should have a very strong, if not a CFO, at least a controller who's familiar with that and familiar with how you can leverage that line of credit or lines of credit or whatever the case may be effectively, right? Because it's not for the faint of heart, and you definitely need to make sure that you're doing your due diligence there as well, right? I think the other big piece that I would throw in there in regards to that is the idea that you mentioned the cost cutting, right? Again, if 2008 taught me anything, right? And we're definitely on the edge of a recession, down in a recession, wherever you want to call it that we're at. There's definitely categories of business for certain. Real estate, mortgage industry, certainly one of them right now, that don't have the cash flow that they had literally a year ago, right? There's people in the mortgage industry that a year ago were, if they produced $400,000 in total commissions as a solo or maybe 2 or 3 person office, they're doing a fraction of that, and we're not talking like half. It could even be a third or a quarter of that, right? I mean, it's big time ugly in that particular category of business right now. So my point is, without credit, without credit, you're screwed. But that's not even a good thing, because there's no guarantee that that's going to rebound in the next 3 months. So the other question is how do I cut back? What are the costs? What are the costs that I can scale off, or I can peel off and reduce my cost exposure, drop down my expense load? There's a lot of pieces that go into that. And one of the things that we will often encourage our owners to consider, like, for instance, those that take salaries, don't take a big salary, take it in distributions. That way you don't get fixated on a lifestyle. Let's say, for instance, a business does $1.5 million a year and they net $250,000. You could easily pull a $200,000 salary as the owner of that business, right? I mean, assuming the math and everything like that, but that should support a $200,000 salary. However, if it were me and I'm talking to the client, I would suggest that they do maybe $100,000 salary, maybe even $80,000 salary, whatever it takes to pay the necessary minimums, and then take either quarterly or semi-annual or even annual distributions. One, I can't give tax advice, but one, it's a better tax positioning. But more importantly, two, it's a better scenario for the business. Because if there is a situation like this where all of a sudden 6 months later the business isn't what it was doing before, but you got yourself committed to a certain salary level or whatever the case may be to maintain your lifestyle, and you've adjusted your lifestyle accordingly, now all of a sudden you got a huge nut that you're trying to cover, and the business doesn't support it, and that's a quick way to bury the business. So, being super disciplined in that regard is really important as well. And, what kind of things can you cut costs on? We could spend hours on that. As a matter of fact, we have a referral partner that we reference out. She's a franchise owner of a company called Schoolie Mitchell. And she'll actually be at our event that we're having in April. We've been announcing the last couple of weeks. But, one of the things she does, she helps business owners assess what are all the expenses they currently have and which ones can they afford to kind of cut back on or peel off entirely in some cases. For instance, we have a client right now that's going through that process, and they just made changes on their phones, and they're going to save $300 a month for their phone line system in their offices.
Wow.
We got at $300 a month. I mean, that's a lot of freaking money when you think about it. We got another. They also have they were financing some IT equipment, but they had those big old-fashioned. I say old-fashioned, but the big copiers, printer copier, fax machines, right? The big massive ones with color printing and everything. They don't need that. Nobody does that anymore. I say nobody. Most people don't do that anymore, and they don't really need that. That's a cost they've been incurring for I'm going to tell you the better part of 3 years. And the maintenance costs and the lease costs, I'm going to tell you they probably spend $15,000 in the last 3 years on that. That could have all been going to the bottom line. So $5,000 a year for the last 3 years could have all been going to the bottom line. Now, they're not a bigger business, it's a smaller business, but you start thinking about $5,000 here, $300 a month there. That starts adding up. And remember, that all comes directly off the bottom line, because those are business operating expenses, not cost of goods sold. Those are business operating expenses. Means if I reduce those expenses, I have that much more money to put in my pocket.
Yeah, absolutely.
So, where the market is today, I would encourage everybody to take a very lean approach. That was a matter of fact, in 2006 or 7, when you and I first met, the lean strategy was actually a really a big focus at that time.
Yeah, absolutely. Yeah, it's interesting. You bring up the copiers and print servicing and things like that. It's there's a local company here in Utah that I've noticed recently, right? They've been known for printers forever. I mean, 20 plus years, that's been their bread and butter. But as we're talking about, looking at additional revenue opportunities and kind of pivoting and changing your business as, the market changes, they're now almost 50-50 market or printing and print servicing, but then also IT. So now they're kind of branching into that. It's almost 50% of their business model, because they're getting away from, how many people really need those big printers, like you're saying, but they saw, okay, we're losing revenue here. Where can we add additional revenue opportunities? What are some new services that are similar to what we're doing? Not a totally new business, because people get in trouble with that, but we could service our existing clients in a more modern way. And so I think that's just a good example of how you can, look at your finances and look at where you're generating revenue and make some shifts and add some things to your product or service lineup to make your business a lot healthier. So just, it's funny, as you were talking about that, I hadn't planned on sharing that, but it was kind of an interesting thing I noticed this week.
Yeah, absolutely. Great point. And to your point there, one of the things that we do as coaches when we come into the business, we have the both our Jumpstart 12 and our Deep Dive 40. And one of the main things that we do is we go through the business model and we try and uncover those revenue opportunities, to your point, right? Things are down right now. So yes, cut the cost, but at the same time, is there an opportunity to introduce a new product revenue opportunity? I don't know. If they're doing IT, cybersecurity seems to be, I think that was, I read an article, it was seven key things to focus on in 2023 for potential growth. And cybersecurity was number 6 of 7. So, wow. And I don't know that it was necessarily ranked, but it was one of the 7. And so, to your point, I could add a cybersecurity service, and I'll bet you that everybody that you were selling printers to probably had computers, and they probably need cybersecurity service or some kind of solution that's a recurring maintenance revenue opportunity, right? That you could be charging, and it replaces, to your point, the printer revenue that you were bringing in from before on a lease or a maintenance agreement or whatever.
Yeah. And that's really the benefit of bringing on a coach, right? Is that additional perspective and uncovering those opportunities that sometimes you don't see because you're so in your business, you can't detach and see the broader horizon. So
and when you mentioned it, they've been doing it copiers for 20 years.
Yeah.
The reality is, if you did something for 20 years, what is the likelihood that you're going to be able to look at it with a fresh set of eyes?
Right. Yeah.
It's almost not, it's not even realistic to think that you would be able to, because you have, it's not the tunnel vision that you get locked into, but it's also an emotional attachment to it.
Right.
Nobody wants to be wrong.
Yeah.
Right. Absolutely. So it's hard to step back from it and say, okay, if we're not getting what we want, what could we be doing differently? And sometimes, like I said, it just takes that fresh perspective of somebody else saying, hey, just out of curiosity, would you ever think of doing this?
Yeah. Right. Very true. Cool. Well, hey, as we're talking about changes, I think one of the other things that's worth noting is, with SVB, but just in general, is so important to stay informed. And I know that, we're really busy, and, our shows obviously catered towards small business owners who are even busier than most, right? And so it can be challenging to stay up to date on what's happening locally, regionally, nationally, and globally. But I think every one of those is important because they all have an impact. And so I think it's important to find some, quality news sources some newsletters. I subscribe to a number of them, but they refuse to sponsor our show, so I'm not going to mention them by name. But they give you just, more than a headline, but not, hours of reading. Just a couple of key need to know bullets, and then, you're on with your day. So I'd say, reach out, find some of those, and that can certainly help. But always approach the news from the perspective of, how does this impact me? How does this impact my business? And I think that can help really make sure you're looking out for things and understanding things as they're happening, just like SVB.
Absolutely. Yeah. And it to your point, 2 days into this whole debacle, it's it's like, I should probably pay attention to this. Let me do some due diligence. Let me read in a little bit. And initially it happens, you're like, doesn't affect me. 2 days into it, 3 days into it, you hear this on the news for 3 to 5 days in a row, it's going to have an impact on you somewhere, somehow, some way. It's going to have an impact on you. If that got that much attention, chances are there's some kind of fallout somewhere else, right? That you'll feel it. And it may not be a direct impact. It may not be the life-changing or anything like that, but it's at least, to your point, something you should be aware of, because you make better decisions when you have more information. Right. The more information you have, the better you can make a good quality decision. And our challenge as business owners often becomes the fact that we get so caught up in the minutia of our day-to-day that not only do we lose sight of, how to effectively run the business at times, meaning we get focused on, this is what I always do. But in addition to that point, we're also locked into this ideology, I guess, for that what's going on over here doesn't impact me over here.
Right.
And our world is far too global. There's too many things that are interrelated. If I think, I go back just a couple of years ago when Trump was putting all the sanctions in place on China.
Yeah.
That affected every business owner out there. And so the irony is that a lot of people, regardless of how you felt about it from a political perspective, they're all like, oh, this is good, or this is bad, or this is good, or this is bad. Well, if you're the business owner that's buying product in China, and this is causing your costs to go up 40% on cost of goods sold from where you previously were, that's not a good thing. That's and oh shoot, now what do I need to do to offset that?
Yeah.
But if you weren't familiar, if you weren't paying attention to it, which I'm terrible at global news, I'm bad about staying on top of that. And then all of a sudden somebody's like, hey, did you know there was a war in Ukraine? And I'm like, no, actually I did.
Yeah.
That's what I have you for, David.
Right. Well, and you're right, because there's so much to stay up to speed on. And rarely I've found with the newsletters I follow or subscribe to that any one of them captures everything. And so I think that's what
great point.
I mean, you don't want 20 things to look at every day, but a couple good ones that cover a couple different things. And industry specific is another one I didn't include earlier, but like for me, I want to know what's happening in psychology, what's happening in social sciences. Like those are things that are important to me, because that informs the trends and learning 1 to 3 years down the road. So that's something I look at. But other industries, right? You could do the same thing. There's industry newsletters and things that you want to stay abreast of as well.
Absolutely.
Yeah. So, okay. Well, and I think kind of getting to the end of our topics here, and then we'll jump to our key points and kind of action items. But, I think for a lot of businesses, this was a very real crisis. And so I think one of the other things that we can look at from this is, when you're faced with a crisis, when you're faced with a bad situation, is you want to avoid panic and you want to avoid paralysis. Both of those can be really bad for your business, right? And so I think it's important to adopt kind of that middle ground, that pragmatic approach, and dealing with the most immediate problem first and solving one problem at a time. And one of the things that kind of came to light with SVB was, when people were now trying to secure alternate funding, they were trying to get these huge blocks of funding that no bank would underwrite. So instead, one thing you might do is break that down into smaller chunks of financing, and instead of worrying about the big problem that's really daunting, what's the immediate problem? Let's solve that as we're building a strategy to solve the next one. But sometimes you have to take that approach and really just kind of work your way through that process instead of, freezing or, freaking out because you can't get, the $50 million that you need. Well, let's start with the 10 that we need to get through the next 3 weeks and then work on the other solutions. So I don't know, any thoughts on that, Eric?
No, but I mean, yes, but great strategy, right? I mean, the reality is at the end of the day, being pragmatic and practical about situations, in the military or any kind of first responder scenarios, you're always trained into, it's a fight. You're trained to hold yourself against not fall into the trap of the fight or flight mode, right?
Yeah.
Fight would be aggressively going after, and the flight would be running away from or avoiding. And in those scenarios, neither of those are good solutions when you're dealing with a business problem, right? So when something doesn't go the way you want it to or intended it to go, it's certainly easy to get emotionally tied to it and get frustrated, but that's not going to solve anything, right?
Right.
Good, bad, or indifferent, it's not going to matter. I mean, I've watched clients actually have good situations happen and then make decisions based on that success in the short term, only to find out later it was a short-term phenomenon. It wasn't sustainable, and it wasn't going to sustain for any significant length of time, but made decisions based on that. And consequently, 3 months later, had to come back and go, yeah, sorry, we actually hired some people that we shouldn't have hired, so now we need to let you go. Right. Yeah. It's like there's nothing more disruptive than doing something like that. I mean, bad enough that you, in the shortfall that you miss something, but to make a decision like that, bring people in and then turn around and say, yeah, sorry, we're going to let you go. Not so good. Bad for the employee they had to let go. Bad for you because you got to go through it emotionally and deal with that. Bad for the existing employees because they're like, what's going on here? Does this guy know what he's doing? Does this lady know what she's doing? All right. So all the way across the board, those are just bad scenarios. And that's in a good situation. That's when things were good. Right.
Yeah.
So, and it's funny you mentioned the whole managing through the crisis. I know one of my clients was probably, third or fourth client that I started working with. And I remember walking in and he was a major payroll issue. And he just switched payroll companies and they completely screwed it up and nobody got paid. But they took the money out of his account, but they didn't get paid. And the only way he could pay his people on time, and they're asking for the money. And he's writing not personal checks, but he's writing live checks out of the business account. But the way that he did that is he had to transfer money out of his personal account into his business account because the funds had already been withdrawn and they couldn't guarantee they were going to get them back to the employees in a timely manner. So he's freaking out. And I remember it was like one of our coaching sessions and I walked in on a Friday morning, which is payday in his world. And or that particular Friday, I don't remember, but I walk in and I'm like, he tells me everything's going on. And I'm like, so do me a favor, breathe. I said, now, here's what I want you to understand. It's okay, because this is not the last time this is going to happen.
Yeah, right. Yeah.
This too will happen again. It may not be this exact scenario, exactly the way that happened, but something like this will happen again. And you're just going to have to take it in stride. I mean, a good leader, right? That's actually another piece that I would add to that, to your point, David, and this is up your alley, but good leaders know how to manage crisis, right? They know how to keep a level head. They know how to strategize and work through and, get through the emotional component, because you can't avoid dealing with the emotion.
Yeah.
But manage through the emotional part as quickly as possible and then get to okay, this is going to make an impact. This is going to improve the situation. This is how I'm going to solve this, even if it's in the short term. And then we'll work on a long-term solution, to your point earlier. But the reality is it takes a good level-headed person to be able to do that. And anybody who's in a leadership role or somebody who's running an organization, you have to be capable of doing that, because you will, if you're a small business owner, and I don't think we've ever shared this on this show, but I saw it one time in a cartoon, and it was the what people think their path is going to look like in starting their business. And it starts here in the bottom left, and it's like a 45-degree angle straight up to the right. And it's like, this is what you think it's going to look like. And then what it really looks like, and it's like a squiggly line going all over the place, different directions. So and so at the end of the day, every one of those pivots represents some kind of decision tree or process you had to work through, right? Is it something good or bad? Regardless, you had to make a decision, and some of that is crisis that you have to work through. So.
Right. Yeah, absolutely. No, and that's very true. And just our final talking point here, and then we'll do key points and action items is Nothing adds to a crisis like silence. And so I think that it's so important to communicate with your employees, with your customers. And going back to something you said, Eric, it may not affect you at all, but if it's dominating the news, you need to address it, right? And let your people know and reassure them, hey, we're good, we're funded. I've checked in with our bank. I've talked to the, CEO at our bank, and he's assured me everything's good to go. And here's why it's good. And here's what I've done, the steps I've taken to protect us, and how we've, diversified our risk. And you may not need to go to nth level of detail on it, but I think when you're that proactive, especially with your employees, but also with your customers, and sending out a newsletter that, hey, you're probably seeing this, don't worry, we're all good, we didn't bank with them, we've got 3 other banks that we use and all of them are solid, like that does so much for your goodwill with your employees and your customers. You wouldn't believe it. So I think that's one of the key things is, do your due diligence, gather the facts, gather the information, and then communicate, as quickly as you feel comfortable, because you want to make sure that, the rumor mill isn't getting out ahead of the facts. And if there's an absence of information, people tend to create their own, right? I think we've seen that.
That's right.
Yep. And so it's just super important to proactively communicate in these situations, especially in crisis.
Yeah, great point, David. I couldn't even add to that. That's dead on. The only thing I would say is that I think that we had probably one of the best examples we could have possibly had in our professional careers when we were at Express.
Mm-hmm.
I felt like, for the most part, the owners, at any time that there was a questionable concern or some angst that was building or something like that, the owners were really quick to share details. Yeah. Particularly with the executive leadership and then with the middle management, and make sure that we were, if there was unfounded rumors or something like that, they would squash them and allow us to stay focused on what we needed to do and get the job done on a day in and day out basis. And that is, again, great leadership, right? A good leader knows and recognizes that there's disruption in the model, and I need to go and deal with that now, because that'll only make things better if I address it and deal with it now.
Yeah. Yep. Absolutely. Well said. And yeah, couldn't agree more. Just an amazing example to follow for sure.
Agreed.
So, cool. Okay. Well, hey, let's recap a couple key points. We covered a lot of information throughout the episode here today. I think one of the main things is make sure you're keeping a close eye on cash flow and expense management. We also talked about looking for ways to reduce your reliance on high interest funding, right? Because that's only going to get harder. Look up alternative partners for your business. Specifically, we're talking banks here today, but that applies to vendors, supply chain, all that. Subscribe to a couple go-to news sources that are going to push information and updates to you, so that'll save you time but keep you informed. Adopt that pragmatic approach to managing a crisis that we discussed, and make sure you communicate proactively. And then in terms of action items, go check your bank's health today, right? Make sure that where you have your money right now is safe. I mean, not even exaggerating, like hit pause, actually after Eric talks, then hit pause, and then go check your bank, make sure things are good. And then also, just touting our services, but this is, certainly an important thing that everybody should consider, is working with a coach to help you navigate your business finances, right? I think this is very apparent that you need to be protected. And if you're not sure how to do that, you're not sure what steps to take, you're not sure if you're in a good financial position, reach out to My Biz Coaches. And I'm sure they would love to walk you through, again, that Jumpstart 12 or that Deep Dive 40 to really make sure your business is in a good spot. So those are a couple action items. Eric, let's talk real quick about your live event on the 7th and 8th, and then anything else you've got happening at My Biz Coaches.
Thanks, Dave. Appreciate that. So yeah, to your point, we have our live event on April 7th and 8th. We're super excited about that. We have 10 speakers that'll be in attendance. Excuse me. There's 8 represented there on the flyer. Thomas and Sarah will be joining us at the event. We're ecstatic about having him there. Hannah Johnson and Ed McIntyre, who've been on the show, will be talking about wealth management. So it'll be exciting to talk about them. Hannah also does insurance, so business insurance is our primary focus. So having her there to share thoughts and insights. Dustin is a marketing genius. I love just sitting and thinking through different ideas on how you can, different marketing strategies on how to kickstart a business and really drive revenue. Brandon's the CEO of HOA.com, but he also wrote the book Raving Referrals, and what they're building at HOA in regards to a network referral system, or activating your network, so you can leverage a referral solution. And we all know that the best form of new business is through referrals, right? Then we got Jack Duchesne. His Next Evolution is a personal development organization. One of the things he's going to talk about is the mindset of a business owner. So kind of referenced earlier about the life cycle of a business. But then we have Chris Posey, who's been on the show as well, talking about HR, payroll services, things like that. And then Robin Bowles is going to join us in regards to talking about reducing expenses. So as we talked about today, how valuable it could be to take a hard look at some of your expenses and figure out where you can cut costs. We have a few other speakers as well. So super excited to be able to bring that group of people together. This is the first of what will be many of these types of events. We have, based on the strength of putting this one together, we're already excited about what we're going to do here in the fall coming up. So if you're in the Phoenix area, it's 3 weeks away, so you have an opportunity. The tickets are on Eventbrite. You can, David had the flyer up there with the promo or the QR code. You can scan that and go ahead and purchase your ticket. But and if you're not in the Phoenix area, we will be at least recording it, and you'd be able to get a copy of the recording after. We also have the opportunity. There's a possibility we'll make the announcement here next week or two. Excuse me. But we'll make an announcement on whether or not we will live stream the event. So we're excited about the opportunity to potentially do that. But should be a lot of fun. Food's included, breakfast and lunch both days. So lots of great, powerful people, and should be a great, awesome time.
Awesome. Cool. Well, yeah, I know a lot of planning, a lot of work has gone into it. Eric was humble. He didn't mention, but he's going to be, of course, speaking as well at the event. So if you even like just a little bit of what you hear on our episode, you're going to want to see Eric live and really dive deep into some pretty cool stuff. So be sure to check it out and get your tickets. So with that, we'll wrap up for today. As always, we appreciate those who watch and listen. And if you haven't already, be sure to subscribe so you don't miss future episodes. And again, we thank you for hanging out with us here on the Biz Coach Show. Eric, we'll see you. Thanks.
Thanks, David. Appreciate it.
Yep.